If charts look random to you, this video will change that. Today, I'll break down market structure, the simple framework professional traders use to know when to buy, when to sell, and when to stay out. If there's one concept every serious trader must master, it's market structure. Indicators come and go, strategies evolve, but market structure is permanent. It's how price naturally moves. Once you truly understand it, charts stop looking random and start telling a story. Market structure simply means how price creates highs and lows over time. That's it. Everything else in trading builds on this. What is market structure? Market structure describes whether the market is trending up, trending down, moving sideways, and it's determined by swing highs and swing lows. Price doesn't move in straight lines. It moves in, waves push, pull back, push again. Those waves create structure. There are only three main conditions. 1. Bullish market structure, uptrend. A bullish structure forms when price creates higher highs, higher lows, HL. This tells us buyers are in control. Each pullback fails to break the previous low, and each push creates a new high. That's institutional accumulation in action. In a bullish market, you look for buy opportunities. You wait for pullback. You trade in the direction of the trend. Trying to sell in a bullish structure is fighting momentum. 2. Bearish market structure, downtrend. A bearish structure forms when price creates lower lows, LLL, lower highs, LH. This shows sellers dominate. Every rally gets rejected lower than the previous one, and price continues printing new lows. In a bearish market, you focus on sell setups. You wait for retracements. You trade with the downside momentum. Buying in a bearish structure is emotional trading. 3. Range or consolidation. Sometimes price does neither. It moves sideways between support and resistance. This is consolidation, smart money, accumulating or distributing positions before the next big move. Ranges are dangerous for beginners because false breakouts happen often. Direction is unclear. Emotions rise. Professionals wait for a clear break of structure before committing. Break of structure, boss. The turning point. A break of structure happens when price violates a previous high or low that defined the trend. For example, in an uptrend, price breaks below the last higher low, potential bearish shift. In a downtrend, price breaks above the last lower high, potential bullish shift. This moment often signals trend reversal or continuation confirmation. Boss is powerful because it tells you when control changes hands. Change of character, CHOCH. Before a full trend reversal, you'll often see something called a change of character. This is the first sign that momentum is weakening. Think of it as the market whispering before it shouts. Smart traders listen. Why market structure matters? More than indicators. Indicators lag. Market structure leads. Indicators react to price. Market structure is price. When you understand structure, you know trend direction. You know where entries make sense. You know where stops belong. You know when your bias is wrong. It gives context to everything. Even classic concepts like Dow Theory are built entirely around market structure, higher highs, higher lows, and trend phases. Modern trading frameworks, including institutional models, still rely on this same foundation. Top-down market structure, multi-timeframe bias. Professional traders don't analyze one timeframe. They start from higher timeframes and work downward. Example: daily overall direction, H4, key structure zones, H1, M15 entries. This creates alignment. When lower timeframe trades agree with higher timeframe structure, probability increases dramatically. This is how patience becomes profit. Common beginner mistakes. Let's be real. Most traders lose because they trade against structure, enter mid-move instead of on pullbacks, ignore higher timeframe, bias, chase breakouts emotionally, overcomplicate charts. Market structure forces discipline. It teaches you to wait. Market structure is not about prediction. It's about confirmation. You're not trying to guess where price will go. You're waiting for price to show you. That's the mindset shift. Structure gives confirmation. Confirmation gives confidence. Confidence removes fear. Final thoughts. Market structure is the language of the market. Once you learn to read it, you stop gambling and start trading with purpose. No more random entries. No more emotional decisions. No more chasing candles. Just clarity. Master market structure. And every strategy you use afterward becomes sharper, cleaner, and more profitable. Because in trading, structure comes first. Everything else is secondary.